Okay, I'll now move to mergers and acquisitions and corporate restructuring, which is chapter 14, and chapter 13 is on business valuation. These two are interrelated areas. Some question I may discuss in valuation, some same question sometime in some batches I discuss in mergers and acquisitions. So technically there is no big difference between these two chapter, which is mergers and acquisitions and corporate restructuring and business valuation. Let's just first broadly understand the context as to what we are trying to do. In M&A, our entire analysis is to analyze how the merger is going to be to these two set of companies, AC and TC. We'll use these two terms whenever I'm solving the question. AC is acquiring company, TC is target company. A company which is acquiring someone else is called acquiring company, and which is getting acquired is called target company. Our major analysis is whatever merger you are saying, is it favorable or unfavorable for these two set of people, the acquiring company and target company. When we evaluate, we're going to learn about various terms like how much is the gain from the merger, how is this gain given to category AC guys, how much goes to TC guys, what is the cost of merger, what is the gross cost of merger, what is the net cost of merger, what is exchange ratio or a swap ratio, how is it calculated, what is weighted average exchange ratio, P multiple, combined P multiple. So different concepts, interrelated concepts is there. Major chunk of the question chapter is on mergers and acquisition. Some part of corporate restructuring is also there. Like you have one question on demerger, one question on internal reconstruction is there. Internal reconstruction is something you would have learnt in accounting. So there are 2-3 questions around that as well. But predominantly it's on mergers and acquisition. Now, give me a minute. Merger primarily happens because of two reasons. Okay, I'll show you with this example. 2 lakh is the profit of AC. Okay, 5 lakh is the profit of TC. We normally follow the order of writing AC first and TC second. That mindset was always there, and ICI used to do. In one exam, they switched the order and students made mistakes. So that all this is something which they keep trying. So AC is to TC is the order, but 90% of the question AC and TC only the balance sheet will be given. But sometimes they'll switch it as TC and AC. So 2 lakh plus 5 lakh can become 8 lakh. This is called operating synergy. This is called operating synergy. That is, my profits of the combined entity is better than the profits of the individual entity, is better than the profits of the sum of the individual entity. That is called operating synergy. Why a merger is happening. Example, Bharadwaj Institute and some other teaching institute want to merge together because we were unnecessarily cutting their market, they were cutting our market. So our marketing cost will go down, our pricing can be better, we have better market share, we have better strength. So we are merging together, our overall profits will be better than the individual profits. That is one merger. Second merger is financial synergy. What is financial synergy is market suddenly views this company differently. See, I went to a bank, asked for a loan, saying that give me a loan. Bank said 14% rate of interest. I said my business is very good. He said 14% rate of interest because he feels I'm risky. My business, same business, Tata's acquired the business. Tata's acquired the business, and now Tata's is asking for a loan. Tata is asking for a loan. What will be the rate of interest? It will drastically go down from 14. It will go down to 8, 9, 5, any number, because the risk is not there. It's not on the business. It was because Dinesh Jain was doing the business, vis-a-vis Tata is doing the business. So obviously the risk has gone down. So when two businesses merge together, the financial risk may go down. The financial risk may go down. One way of evaluating the financial risk is P multiple. One way of evaluating the financial risk is P multiple. Inverse of P multiple is technically called cost of capital. Inverse of P multiple. That's not a formula we use everywhere, but inverse of P multiple is cost of capital. So I was feeling this business is 5% risky. Okay. This business is 10% risky. When you merge together, average some 7, 8, weighted average we have to do. It should be some 7.5 or 8.5 or 8 or 6. But business is saying it is risky what? 5%. It is risky only 5%. So this is an example of a financial synergy. This is an example of a financial synergy. See, earlier what was happening? 2 lakh was the profit. 2 lakh was the profit. P multiple is 20 times. P multiple is 20 times. The value is 40 lakh. Let me be very clear. We will use this format to solve all the question. We start with PAT. You divide by number of equity share, you will get EPS. Then you do multiplication P multiple, you will get MPS. Again, number of equity share, you will get market value of firm. This 40 into 1 lakh is not the formula for market value of firm. 40 into 1 lakh is not the formula, but that's what you will do. What is the formula? Is PAT into P multiple. That's the real formula. The real formula is PAT into P multiple. PAT is 2 lakh. P multiple is 20 times. 2 lakh into 20, 40 lakh rupees. This is 5 lakh into 10. 5 lakh into 10, 50 lakh. 40 plus 50 is becoming what? 1 crore 40. 40 plus 50 is becoming 1 crore 40. The reason is very simple. 2 lakh into 20 plus 5 lakh is also into 20 now. 5 lakh is also into 20 now. So market has given you a financial synergy gain. Market has given you a financial synergy gain. There are two types of synergy gain. One is the financial synergy and second is your operating synergy. Operating synergy is PAT level gain. Financial synergy is at your P multiple level. It is a gain at P multiple. Ultimate gain is valuation gain. Ultimate is valuation gain, which can gain both because of both or because of one. 90% of the question you will have only financial synergy. Only very rarely they'll give you operating synergy. If a question gives you any synergy gain, unless in exceptional cases, it will be PAT level synergy gain. It will be PAT level. Question will say there's a synergy gain of 5%. 2 lakh plus 5 lakh, 7 lakh, add another 5% profit. Add another 5% profit. So mostly it will be synergy gain at a PAT level. Mostly it will be synergy gain at a PAT level. Very rare scenario, it could be a directly valuation. P multiple and all, they'll not give synergy gain directly. So on the P multiple, there is a rule. The rule is if the problem is silent, pre-merger P multiple becomes the post-merger P multiple. Pre-merger P multiple becomes the post-merger P multiple. This is a rule as far as your mergers and acquisition is concerned. Whatever was the pre-merger P multiple, it will become post-merger. You see 20 and 10, I copied 20. I copied 20. Pre-merger P multiple of whom? AC. AC. Because AC is what is continuing. AC is what is continuing. Clear? Any doubts on this? I'll come to these later. Yeah, let's see in a question and then I come back on. Few of the points I'll come back later. Question 4. Page 513, question 4. Go through question 4. Okay, go through the question. Please quickly go through the question. Every problem we are going to put it in this format and solve it. You'll understand when we do the questions. And in fact, this is the question which was there in that MTP which I showed. I showed you one MTP sometime in the beginning. This is the 8-mark MTP which came. 4 MCQs were there. 4 MCQs were picked from this. Okay. A Limited wants to acquire T Limited. Swap ratio is 1 is to 2. Following data is given. Number of equity share, EPS, all this my table is going to give. All this predominantly the table is going to give. Let's directly start doing the question. So working note 1, merger table. Merger table. Which is the AC. AC equal to A Limited question I'll explain in detail. In case there are doubts, please let me know. C equal to limited. Now listen, when we prepare our table, particulars, A limited, T limited, merged. But you need to have extra columns because merged I can do one rework, two rework, three rework in the question. So normally I tell students have space for 6 columns. We'll open only 4. We'll open only 4. Needed the 5th column will open. If needed another column will open. And if further needed then we'll have to recreate the table. Then we'll have to recreate the table. Particulars, A limited, T limited and merged. AT and merged. A limited, T limited and merged. Our format is PAT, number of equity shares, EPS, E multiple, MPS, again number of equity shares and market value of equity. Very simple format we have, starting from PAT and going on till market value of equity. Same format out. I think this chapter has around 50 questions. I can solve at least 20 questions using this format. Same format, I'll solve most of the questions. Question may give in this order, they may give it differently also, doesn't really matter. I can start solving them with this information. For the PAT given for A limited, 18 lakh, limited, work will see, merged will see it later. Number of equity shares, 6 lakh and 1 lakh 80. EPS, P to P multiple, 7. MPS is 14. Again number of equity share. So I am doing MPS into number of shares. The real formula is PAT into P multiple. The real formula is PAT into P multiple. That's the formula to calculate the value. Because value depends on how much PAT you are generating. Because per share and all can be easily altered. How I say easily altered? If you suddenly make a bonus or a split, the number of shares will automatically change in the practical world. Now our job is to complete that merge table. Okay. Anywhere is there any synergy gain? The question is talking. Initially, don't tell me the last situation. Any synergy gain? Just add the profits. 18 lakh plus 360. 18 lakh plus 360. Below the table, number of shares issued to TC. TC is target company. Issued to target company. Number of shares issued to TC, which is the target company. Issued to TC, which is the target company. How many shares are there in target company? Against this, I may issue more, less. That's my wish. That's the swap ratio given. What's the swap ratio? 1:2. So into 1/2. I'll give 90,000 shares. I'll give 90,000 shares. So I had 6 lakh shares in A limited. Extra 90,000, it will become 6 lakh 90,000. EPS 4 decimals. If it's in decimal, please work with 4 decimal to avoid rounding of gap. 3.1304. You can read the question if nothing is given. Same ACP multiple continues. I think here it given also. They've said what is the market price after the acquisition, assuming the P multiple remains unchanged. P multiple remains unchanged. So in NPS, $31.3040. Number of shares is 6 lakh 90, and I do multiplication. It is 2 crore 15 lakh 99,760. In my solution, I'll give two answers. I'll say 2 crore 15 lakh 99,760 rounded off. Rounded off to what is rounded off? PAT into P multiple. PAT into P multiple is the right value. PAT into P multiple is the right answer. So it is 2 crore 15 lakh 99,760. Sometimes I say leaves here. Sometimes they say let's round it off to 2 crore 16 lakh. The issue with the rounding off is our EPS was in decimal. Our EPS was in decimal. If the EPS was not in decimal, all this problem will not happen. PAT into PE multiple is the right value. PAT into PE multiple is the right value, but in the market it may not happen because of the rounding off. Any doubts on this? Now tell me what are the requirements of the question. What is the first requirement? Done. Second requirement. Done. 3.1304. Third requirement. I'll explain that in some time. Fourth requirement. Done. 31.3040. There in the table. Fifth requirement. Market value of the merged firm is, I'll write it like this, 2 crore 15 lakh 99 760 rounded off to 2 crore 16 lakh. What is 2 crore 16 is 2160 into 10. PAT into P multiple. PAT into, in exam, don't leave it in this table. Below the table, keep answering one by one, whatever they've asked. They have told what is EPS after acquisition. Below table, write EPS after acquisition 3.1304. MPS after acquisition 31.3040. So you keep writing that. Okay. I'm yet to do equivalent EPS. I'll come to that in a minute. What is the last requirement? To achieve EPS of 3.5 in case there are synergy benefits of 10% during post acquisition period. I will open extra column now. Merged situation 6. Merged situation 6. Merged situation 6. Because suddenly they have given me some extra rework scenario. In the rework scenario, certain synergy benefits they have talked about. Something on the EPS they have talked about. Something on the EPS they have talked about. So they are saying what should be the exchange ratio? 1:2 is not acceptable. 1:2 is not acceptable. I want a EPS of how much? I'm writing EPS as 3.5. Okay, this is a requirement. EPS is 3.5, and what they have told 10%. So PAT is 18 plus 360. Add another 10%. Add another 10%. So 2116 to 10% is 2376. Number of equity shares is balancing figure. Beyond this, I'm not doing the table. I don't need it. If I want, I can do the table, but beyond this, table is not needed because question has just asked only till EPS. They have not asked anything on the rework part. Original part, entire thing was needed. So what is the number of equity share? 6,78,857, which means 78,857 is what you are giving. 6 lakh is your original share. Extra 78,857 shares we are allotting. Extra 78,857 shares we are allotting. Any doubts on this? Any doubts on the extra allotment? Any doubts on the extra allotment? Can I proceed? So right below, extra allotment. Extra allotment. Shares allotted. Shares allotted 678,857 minus 6 lakh. This is not the answer. This is not the answer. 78,857. Exchange ratio. This 78,857 is for how many shares of TC? 1,80,000, or give me a 4 decimal answer. 78,857 divided by 180. 4? It's to 1. 0.4381 is to 1. That is, they were originally asking for 0.5 is to 1. We are saying 0.4381 is to 1 is what I'll give. 0.4381 is to 1 is what I am planning to give you. Don't ask me for that higher ratio. Any doubts on this calculation? Any doubts on the calculation? Very simple format. I've just taken only item I'm yet to discuss is equivalent EPS. Only item I'm yet to discuss is equivalent EPS. Now I'll discuss the logic of equivalent EPS first. I am the owner of AC. I am the owner of AC. 100 shares I had in AC. 100 shares I had in AC. Because of merger, my 100 will remain 100 only. Because of merger, I had 100 shares in AC. My 100 will become 100. In TC, I had 100 shares. In TC, I had 100 share. Target company, I had 100 share. In merger, this 100 may become 50, 200, 250, 300, 50, 60, 40. It can become anything because of an exchange ratio. What is the exchange ratio offered here? Original part. So my one share becomes half a share. My one share becomes half a share. So this 3.1304 is not my EPS. The TC is saying it's not my EPS. So TC is also a shareholder now in the merged company. See, If I am the shareholder of A Limited, I'll say my 3 rupee EPS is becoming 3.13. You cannot say 2 rupee EPS is becoming 3.13. You cannot say 2 rupee EPS is becoming 3.13 because you did not get one share. So what is equivalent EPS is post merger EPS into the exchange ratio. Into the exchange ratio. So equivalent EPS is this into 1 by 2. Into 1 by 2. This is equivalent EPS. You can do equivalent MPS also. You can do equivalent MPS also. What is the purpose of doing this? I will say my 2 rupees is becoming 1.57 or my 14 rupees is becoming 15.65. My 14 rupees is becoming 15.65. I can do that comparison now. I can do that comparison. Earlier that comparison was not possible. Earlier that comparison was not possible. Now I can say 14 is becoming 15.65 or your 1 rupee is becoming, sorry, 2 rupees becoming 1.57. Any doubts in this? This is the concept 9. Okay, concept 1 is done, concept 9 is done. Equivalent EPS or MPS of target company is equal to post merger EPS into exchange ratio, EPS or MPS, whichever way you want to do it. Concept, no need to get to the concept book. I'll tell you when you want to see it. Whichever, for the timing, just see the screen. Wherever I tell you, please open the book. There, that time you see it. Any doubts on this question? Any doubts on this question? So I've introduced the merger table. I've introduced one concept called equivalent EPS. I've introduced equivalent EPS or MPS. Let's come to question 6. Following information is provided relating to the acquiring firm Mark Limited, target firm Mask Limited. Particulars: Mark Limited, Mask Limited, earnings after tax, number of shares outstanding, P ratio, swap ratio based on current market price, EPS after acquisition, expected price, market value of the merged firm. Only add on is gain or loss for the shareholders of two independent company. Gain or loss for the shareholders of two independent company, which I want to explain. Before I start, last question, what was the exchange ratio? 1:2. Some question exchange ratio will not be given. They will not give you the exchange ratio. They'll just tell you the basis of the exchange ratio. They'll just tell you the basis of the exchange ratio. Write the base values in the order of AC is to TC. What can be the base value? EPS, MPS, book value per share, growth rate, NPA, capital adequacy ratio, anything can be. Whatever is the base value, right? AC is to TC and then switch it. One caution point for you is, for example, today the market price is 40 AC. Target company is 10. So base value is 40 is to 10. Swap it 10 is to 40. Swap it 10 is to 40. So you should allot one share for every 4 share. You should allot one share for every 4 share. Now company is saying, I understand your base value and all, but I want to pay extra. I want to pay extra. So I want to pay a premium of extra 50%. Premium of extra 50%. Then your base values are not 40, 10. Base value is 40 and 15. The 10 rupees you don't want to pay. You want to pay extra. You want to pay extra. Example, MPS of company A is 50. Company B is 20. A wants to acquire company B by paying a premium of 25%. This came in exam. Student made mistake in swap ratio. You know what will happen later, because moment you write wrong swap ratio, EPS wrong, MPS wrong, market value wrong, everything went wrong. Everything went wrong because they took the wrong swap ratio. And he was very confident saying that I should have got the full marks because you made the mistake at the first stage itself. At the first stage itself. Here what they are saying, I want to pay extra 25. So base values are not 50 is to 20. Base values 50 is to 25. 50 is to 25. What is 25? Is 20 plus extra 25%. 20 plus extra 25%. So 50 is to 25 is the base value. 25 is to 50 is the exchange ratio. 1 is to 2. I'll show you that question which came in exam. And many students were very confident, but ICI just made this. A very simple question. They just said this. Premium of 25% over the market price. Premium of 25% over the market price. Unfortunately, that premium was not considered in the calculation. Balance I need not even discuss. Balance what happens? I need not even discuss. Let's go back to this question. Why I discuss what is this exchange ratios? Because here they are saying exchange ratios on the basis of what? Current market price. They have not given the exchange ratio. Let's put it in our format. Particulars, mark, mask and merged. Which is the AC? AC equal to, every question first write AC and TC. Mark limited. TC, mark, masked and merged. We'll put first in this format, first two companies, then we'll put the merged one. First we'll put it for two individual companies and then for the merged one. Was a pat given? I think we'll do it in lakhs. If data is there, let's copy it. Otherwise, whatever data they have given, 2000 and 400, then they have given 200 and 100, and then they have given 10 and 5. Whatever data is available, just write that alone. Balance automatically, the format will throw. Automatically, the format is going to give you the balance answer. Was the EPS 10 and 4. EPS is 10 into 10, 4 into 5. 10 into 10 and 4 into 5. Number of shares continues to be 200 and 100. Market value is 20,000 and 2,000. Any doubts on this? It's a very simple format. Just written the base data. I've just written the base data. 20,000 and 2,000 are the values of the two companies. I'll come to the merge. First, I want the exchange ratio. After that, everything is a formality. So come down, exchange ratio. They have told the basis of the exchange ratio. What is the basis? Market price, MPS, base value. AC is to TC. What is the market price from the table? 100 is to 20. Exchange ratio, swap it. 20 is to 100 are technically 1 is to 5. 20 is to 100 are 1 is to 5. Write the base values and then do swapping. So we've written the base values and then we have done the swapping. Clear? Now we'll club them together and then complete the table. One extra add-on alone I'll have to discuss. 2000 plus 400 is 2400. 200 plus what? 100 into 1 by 5. 100 into 1 by 5. Again, I'll have an issue with the decimals. Can't help it. EPS is 10.9091. Anything mentioned in the question about P multiple? Okay, so 10 I copy paste. Price is 109.0910. Number of shares is 220. Value is 24,000.02. Rounded off to 24,000. Rounded off to 24,000. My objective was to just revise the table again, but I want to discuss the last part of the question. Which is gain or loss for the shareholders. Gain or loss for the shareholders. Any doubts on 24,000.02? Clear? Can you proceed? Any doubts on the table? Now let's look at swap ratio based on current market price written 1 is to 5. EPS after acquisition is 10.9091. Market price after acquisition is 109.0910. Market value of the merged firm 24,000.02 lakhs, rounded off to 24,000 lakhs. Gain or loss for the shareholder. Now listen. The gain or loss can be calculated using market price, can also be calculated using earnings per share. The best method is market price, but ICI sometimes does EPS also. time permits, we can do both in exam. Now, for example, Mark is saying my 200 rupee share has become 109. My 100 rupee share has become 109. 9 rupees is my profit. 9 rupees is my profit. Mask is saying my 20 rupee share has become 109.0910 into 1 by 5. Into 1 by 5. For one guy, you have to compare the normal price. For the other guy, you will have to compare the equivalent price. And accordingly, you will get the answer. I'll do the calculation in some time, but please show it here. Gain or loss or impact of merger on EPS or MPS will start with post merger market price or earnings per share, depending on which approach you are following. Normal value for AC, equivalent value for TC. Normal value for AC, equivalent value for TC. Subtract the pre merger price, which is a normal value. You will get the gain or loss per share. Multiply with the pre merger number of share. Multiply with the pre merger number of share, you will get the overall gain. You will get the overall gain. Now, in my printed solution, I have not consistently followed this format. I feel bad about it, but I have not consistently followed. In exam situation, wherever they ask gain or loss, just think about this. Post merger price less pre-merger. If you are doing at price level, if you are doing at EPS level, post merger EPS less the pre-merger EPS, less the pre-merger EPS. Nothing for you to note it down. We'll solve this in this question, but it's there in the concept book. It is there in the concept book. Let's come to this question. Particulars. AC shareholders, EC shareholders. I'm using the word shareholder because acquiring company and target company names change, merger happens. It is only the gain or loss for the shareholders now. Post merger MPS. I'm doing at MPS level. Post merger MPS. Post merger MPS. What's the post merger MPS? 109.0910. For TC, you will have to do equivalent. For TC, you will have to do equivalent, which is what? Into what? 1 by 5 less merger MPS. Everything there in your, sorry, 120 gain or loss per share. Both are gaining 9 and 1.81. Both the parties are gaining. Pre-merger number of shares 200 and overall gain. Multiply. Overall gain multiply. You will have to multiply with pre-merger number of share because we have used the word equivalent. We have used the equivalent MPS. So equivalent means we are going back to the pre-merger date. Going back to the pre-merger date. So some students by mistake for TC have taken the post-merger number of share. That is wrong. Now I'll show you the proof. Put together the gain is how much? 2000. What is this 2000? 20 plus 2000 is becoming 24. 20,000 plus 2000 is becoming 24. That extra 2000 is the merger gain. That extra 2000 is the merger gain. And this merger gain is not because of operating. It is because of financial. It is because of financial synergy. Operating 2000 plus 400 is only 2400. But financial synergy 10 and 5 has become 10. 10 and 5 has become 10. So that is what is leading to the gain. That is what is leading to the gain. Clear? Any doubts on this? Next, same calculation. You need not write this now. Okay. I'm doing on EPS. Don't write it because you will end up wasting time there. I'll quickly show you. What is the post merger EPS? 2.9091. Equivalent is 2.1818. Pre-merger and one party is gaining, other party is losing. Overall gain, if you add, 0. Reason is PAT did not improve. EPS can improve only if PAT improves. PAT did not improve in this case. So if somebody is gaining at EPS, somebody has to lose at EPS in this question. In this question, because at PAT level there was no synergy gain. At PAT level there was no synergy gain. The best way of doing, according to me, is only going through your approach of market price. But ICI sometimes have done it at EPS. They may use the word impact of merger on EPS, impact of merger on MPS, gain at MPS level, gain at EPS level. But format is very simple. Start with normal value for AC, equivalent value for TC. Normal value for AC, equivalent value for TC. Compare the pre-merger data, get the gain or loss, multiply with the pre-merger number of shares, get the overall gain or loss. Any doubts on this? Clear? Proceed. Okay, let's continue with the discussion. I have explained some of the concepts. We have done concept on one, how is the exchange ratio determined? The merger table format was explained to you, and gain or loss computation. Let's quickly discuss few more questions. Go through 8. Go through question 8. Okay, here they are saying they have given the table, data is given. We are required to find out new earnings per share of A Limited. Also, I want to ensure that the EPS is not diminished by the merger. Not diminished by the merger. There are two requirements. We'll first put the data in our normal format. In the format, I'll get certain data points. They'll give me the requirement of the question, part 1 of the question. They have not asked for many requirements. So let's put it here. Which is the acquiring company and target company? Acquiring company A Limited, target company B Limited, A, B and merged, A, B and merged, A Limited, B Limited and merged. Let's copy the data, whatever is available. PAT is 10 lakh, 3 lakh, and 3. Then the next data I have is number of shares is 2 lakh and 50,000, and market price is given, which is 75 and 60. This question, if I want, I can do without the table. It will get over faster also. But when to do without table, when to do with table, you may not be sure. So consistently, let's do it with the table and then close it. This problem with the table will take more time if I do it without the table. Without table can give me faster answer, but you may not be very sure when to do it this way, when to do the other way. EPS is how much? 5 and 6. The multiple is, no, so balancing figure. 15 and 10. Number of equity share repeats, 2 lakh and 50,000. Value is 1 crore 50 lakhs and 30 lakh. 1 crore 50 and 30 lakhs. Yep. Any doubts on this? Now I have to prepare the merge table. I'll have to prepare the merge table. What is the requirement of the question? What they want us to calculate? Part 1. So I will not write any of the highlighted parts. I'll just stop at EPS. I'll just stop at EPS. Below the table, basis of exchange ratio. They have given the basis of exchange ratio. Current market price, base values. What are the two current market price? 75 is to 60. Exchange ratio. 60 is to 75 are technically 0.8 is to 1. 0.8 is to 1. Any doubts on this? So 10 lakh plus 3 lakh is 13 lakh. Lakh plus what? 50,000 into 0.8. 50,000 into 0.8, 2 lakh 40. EPS is 5.42. I end it here. That's all. I'm not doing anything beyond this. I'm not doing anything beyond this 5.42. 5.42. My EPS after merger is 5.42. That was the requirement of the question. Question just wanted us to calculate the EPS after the merger, which is done. Any doubts? Clear? Then in the rework, they're saying, I don't want the EPS to be diminished by the merger. Who doesn't want? B Limited. B Limited doesn't want EPS to be diminished by the merger. Does not mean post merger has to be 6 rupees. Does not mean post merger has to be 6 rupees, because for them does not diminish means equivalent for them should be 6 rupees. Equivalent for them should be 6 rupees. Then what should that EPS be? Because I just want the equivalent to be 6 rupees and not the normal, not the normal. So in any question, if the problem says I want EPS to be maintained or I want EPS not to be diminished, if there is no PAT level synergy gain, if there is no PAT level synergy gain, exchange ratio on the basis of EPS will lead to maintenance of EPS, provided there is no PAT level. For EPS, PAT is critical. If you want MPS to be maintained, there should not be PAT level synergy gain as well as P multiple level synergy gain. Both the places synergy gain should not be there. So in case a question wants us to maintain something, exchange ratio to maintain EPS, MPS or BVPS. In case there is no synergy gain, then exchange ratio on the basis of the parameter which needs to be maintained. EPS to be maintained, I don't want any PAT level gain. MPS to be maintained, I don't want any valuation level gain. Book value per share to be maintained, there should not be any revaluation of asset or liability. Assuming there are gains, then you will have to do it in table format, some reverse working. So assume something as X and then do the calculation. We'll say number of shares issued as X. Like that, we'll have to do the calculation if there's a synergy gain. If in that I give you one important caution. Question says want to maintain market price per share. Don't end up do the exchange ratio on the basis of MPS. Reason is most of the question market price will have a synergy gain. Market price will have a synergy gain because of P multiple. This is just a caution note. If the question wants to maintain MPS, we should always try under table approach, as the company may have valuation gain, due to the maintenance of P multiple. In short, we can use same parameter only if there is no gain in that parameter. Only if there is no gain in that parameter. In this question, what needs to be maintained? They're saying EPS. I will first show you the calculation and then I'll prove the answer. So now right below, right, EPS to be maintained, EPS not to be diminished. In this question, is there any synergy gain at PAT level? I'm not talking about P multiple. Any synergy gain at PAT level? No. Basis of exchange ratio, EPS. Want to maintain EPS? Do it on the basis of EPS. Do it on the basis of EPS. Base values, AC is to TC. Base value 5:6. Exchange ratio 6:5. This will ensure he also get my 5 rupees EPS. He also gets 6 rupee equivalent EPS. He also gets 6 rupees equivalent EPS. For me, normal EPS will be maintained. For the other party, equivalent EPS will be maintained. Just to show the calculation, if I repeat here, PAT will be 13. Number of shares will be 2 lakh plus 50,000 into 6 by 5. 50,000 into 6 by 5. EPS will be 5 rupees. A is very happy. His 5 is maintained. For B, the equivalent EPS is 5 into 6 by 5. Equivalent EPS is 5 into 6 by 5. So his EPS is also maintained. His EPS is also, question anyway wanted only B limited not to be diminished. But if B limited is not diminishing, A limited will also not diminish. A limited will also not diminish provided there is no PAT level synergy gain. There is no PAT level synergy gain. Clear? Any doubts in this? So 5 rupees into 6 by 5 or 5 rupees directly. 5 into 6 by 5 or 5 directly. Any doubts on this? Can we proceed?
No.
Yeah.
So can you repeat this topic, sir? This maintain.
Sorry.
Can you repeat this topic, sir?
Which
This is
which?
maintain this this diminished this
Okay.
to repeat.
So if okay, you can go on mute. If a question wants you to maintain EPS, your exchange ratio should be on the basis of EPS. So whichever metric needs to be maintained, you do it on the basis of that. It will lead to, for example, if MPS is to be maintained, exchange ratio on the basis of market price will lead to maintenance of MPS. EPS to be maintained, exchange ratio on the basis of EPS will lead to maintenance of EPS. This is the concept. Yep. Any doubts?
Okay, sir. Thank you.
Okay, sure. Okay, now for calculating the value of the merged entity, there are two approaches possible. This is not covered in my concept book. Unfortunately, I've missed it. So write this alone. Valuation of merged firm. Approach 1, PAT of merged firm, into P multiple of merged firm. PAT of merged firm into P multiple of merged firm. Usual approach, most of the question, this is what we will do. PAT of merged firm into P multiple of merged firm. Approach 2, value of company AC plus value of company TC plus merger gains. AC company value plus TC company value, add the merger gain. This is the second approach of valuation. First approach will be used wherever P multiple data and all is there, wherever the question says on the P multiple. Approach 2 is used if merger gain is directly given in question, or merger gain can be computed based on revision in growth rate of C. You will understand this as we proceed. Based on revision in growth rate of target company. Revision in growth rate of TC. Okay, now what is this? Before I get into this, I discuss 2-3 more concepts and then I come back here. But there are two ways of valuing. This is not there in my concept book. The first way is every question you did this. The merged you are writing here. You are taking the PAT, multiplying with the P multiple and getting the valuation. But some question P multiple data itself will not be there. P multiple data itself is not there. They have given value of company 1, value of company 2. Merged will be 1 plus 2. Can it be more? Yes, if there is a merger gain. What is merger gain? Not the PAT level gain. I'm talking about the valuation level gain. If you're just giving me PAT level gain, again I cannot add it there. I want the valuation level gain. How to do that? You will understand as we do question. Just 2-3 concepts I discuss and then I come back. Few important concepts is, one is called gain from merger, second is called cost of merger, and next is called NPV of merger. All are interrelated items. What is gain from merger is, if mark plus mask put together is not 22,000. If mark plus mask put together is more than 22,000, there is a gain from merger. There's a gain from merger. Who's going to get this gain? AC may get it, TC may get it, or both may share it, or only one person may get it. That depends on the exchange ratio. That depends on, for example, in this question, this 2000 was split as 1818 and 181. But if you change the exchange ratio, one party may gain, one party may lose also. That depends on the terms. Merger gain is mark plus mask put together, the values on the higher side. How it can happen? Three, four reasons. One, P multiple is better than the weighted average P multiple. How to calculate weighted average, I'll explain later. That's the reason for mark and mask question, because 10 and 5 together became 10. 10 and 5 together became 10. Weighted averages around 8 or 9. In between it will be. Or cost of capital is better than the weighted average cost of capital. What is cost of capital? I was showing you the calculation, saying that inverse of P multiple. Inverse of P multiple is the cost of capital. So if cost of capital is also better, if cost of capital is also better, it can lead to synergy gain. It can lead to merger gain. Third, earnings of the merged firm is better than the sum of the individual earning. We saw only one question. There was one rework where they said add some extra 10%. Add some extra 10%. That could be the third reason. Or the cash flows generated by the firm is better than the sum of the individual cash flow. So these two are operating synergy, earnings or cash flow. The first two are financial synergy, which is PAT and P multiple. Just to give an example, cash flow of company A 25 lakh, company B 20 lakh. Merged company will have annual cash flow of how much? 60. 25 plus 20 should become 45. It has become 60. It has become 60. So there is a 15 lakh operating synergy. 15 lakh operating synergy. Pre-merger cost of capital of A 10, B 20. 10 and 20 average should be somewhere in between, but they're saying average is how much? 8. So this is also going to lead to huge benefit. This is also going to lead to huge benefit. The value of any company is cash flow divided by the cost of capital. That's Gordon's formula we discuss in share valuation. So first company value is 25 lakh divided by 10%. 25 lakh divided by 10%, which is 250. Second company 20 lakh divided by 20%. 20 lakh divided by 20%, which is 100. Put together it will not be 350, it is going to be more. Put together it is going to be more. How is it going to be more? They are saving 60 lakh you will get, and 8%. 60 by 8 is how much? So 250 plus 100 should be 350, but you are getting 750. That extra 400 is the merger gain. That extra is 400 is the merger gain. In this question, it is because of both operating and financial. Both operating and financial, because there is a cash flow improvement which is happening, as well as there is a cost of capital improvement which is happening. Any doubts till this? Any doubts till this? Now, a part of this I want to give to the other guy. A part of this I want to keep it with myself. Now, what I want to give, what I keep with myself depends on the exchange ratio. But before that, a company can be acquired in two ways. You can pay cash. You can also give stock. You can pay cash or you can give stock. So the cost of merger is my next discussion. Any doubts on this concept first? Any doubts on this? This next example you can see it home, but the examples are very good in merger chapter. When you see these examples, it will test a lot of your understanding. Okay, now what is the consideration I'm paying? Consideration I pay is called gross cost of merger. Consideration I pay is called gross cost of merger. There's another thing called net cost of merger or true cost of merger. I'll explain that in some time. Consideration paid is simple. If you are paying cash paid per share into number of shares. Cash paid. So you decided to acquire the other company with not 1:2. You said you will pay 90 rupees per share. You will pay 90 rupees per share. So consideration paid is equal to 90 into the number of shares. An example, A Limited is planning to acquire B Limited. B Limited currently has 10 crore shares of, and you have decided that you will pay a cash consideration of how much? 60 per share. So your gross cost is 60 into 10 crore. 60 into 10 crore. That's your wish. You have decided saying that you will pay extra. You will pay extra. 60 into 10 crore is the consideration. Okay. That is if you pay cash. If you are giving shares, consideration paid, your accounting has a different explanation. But in FM, It is number of shares issued into the post merger price. Number of shares issued into the post merger price. Logic for that is, I have given you 1 lakh shares, and post merger it will quote at 20 rupees, 30 rupees, 40 rupees, 50 rupees, 60. For example, in Mask Limited problem, we have allotted 20 lakh shares. We have allotted 20 lakh. Consideration paid is 20 into 109.0910. 20 into 109.0910. In your accounting, you may record this as 20 into 100 also. Pre-merger price. You may record this at 20 into 100. I'm not talking about the accounting part of it. I'm not talking about the accounting part of it. Logic is very simple. I have given you 20 lakh shares. What is the worth of the share? Once the merger is completed, it's 109. It's 109. So, in fact, 20 into 109 is basically I have paid you consideration. I paid you consideration. What is the value of Mask Limited? 2000. So I paid extra. I paid extra. How much extra I have paid? Understand these terms very clearly. I paid extra 181.82. Extra is true cost of merger. Extra is true cost of merger or net cost of merger. Whatever extra you are paying, whatever extra you are paying, and whatever extra you paid is the gain for TC shareholder. Is the gain for TC shareholder. Whatever extra you are paying is the gain for TC shareholder. Is the gain for TC shareholder. Understand? Again, I'll explain. What I'm trying to say is there is a gross consideration and there's a net consideration. Consideration paid is nothing but one, if you're paying cash, cash paid into number of shares. Very simple. If you are giving shares, shares issued into post merger price. Once that is done, subtract the pre-merger value of TC, pre-merger value of target company. That will give you something called as true cost of merger or gain for target company shareholder. In this example, what is the overall merger gain? What is the overall merger gain? 2000. In that 181 is true cost. Balance is my gain. Balance is my gain. 2000 is the overall gain. I said I'll pay you extra. I'll pay you extra 181. Balance left over, who will enjoy? The Mark Limited shareholders will enjoy, which is called NPV of acquisition. Which is called NPV of acquisition. I'll repeat again. In this example, gross cost of merger is 20 lakh shares into 109.0910. 20 lakh shares into 109.0910. Net cost of merger is gross cost minus the pre-merger value of TC. Minus the pre-merger value of TC. 2181 minus 2000. That 181 left over is the gain for the other people. Is the gain for the other people. From the overall gain, if I subtract their gain, left over is my gain or my NPV. Left over is my gain or my NPV. Let's look at this example. Value of A Limited 1000 lakhs. This is a very tricky example. Okay. Value of B Limited 500. Synergy gain. Normally, I said synergy gain means it will be taken at PAT. It will be taken at PAT. In this question, PAT is not possible because there's no PE multiple, no EPS, nothing is there. So in this example which I'm talking about, I am going to use this approach to value the merged entity. This approach to value the merged entity, which is value of AC plus value of TC plus the merger gain. Plus the merger gain. Be in listen mode only, nothing much for you to write. Be in listen mode. So first company has a value of 1000. Second company has a value of, put together the value is 2000. The next headache came. A Limited is acquiring B Limited. Exchange ratio is what? 1:3. Number of shares in both the companies are same before merger. They did not tell the number of shares. They only said number of shares is same in both the company. Your random wish. Any number you can take. So I'm taking 100. 100. I'm taking 100 and 100. Okay. How many shares I'll issue in the merger exercise? 33.333333. This is just to do the calculation. It may not be 100 in the practical one. So I'm going to post merger. It will be 133. This is the pre-merger price. 1000 divided by 100. 500 divided by 100. And 2000 divided by 133 is what? 15. Clear? Any doubts on this? It's not 10 plus 5 is becoming 15. That's more of a coincidence. Okay. So 2000, 1,000 was the value of the first company. 500 is the value of the second company. Put together is 2000. Put together is 2000. 100 shares is there in the first company. 100 is there in the second company. Put together is 133.33. Now they're asked for gross cost of merger and net cost of merger. Gross cost of merger, you calculate and tell me number of shares issued into the post merger price. How many shares we have issued? 33.333333 into what is the post merger price? 15. 33.3333 into 15. 500. What? That is the gross cost of merger. That is the gross cost of merger. I'll repeat again. Number of shares issued into the post merger price. I'm going a little slow on the concept. Let me know if there is a doubt. Okay. Number of shares issued into the post merger price. What is the number of shares issued? 33.33333 into 15. 500 is what I've paid. What was the value of the second company before merger? So net cost is zero. You did not pay anything extra. Net cost can be negative also. Negative also where you are paying lesser than you are paying lesser. So gross is 500 and net is zero. Net is zero. Let's take this example. Net cost of merger is 300. Understand, these examples are very good examples. Pre-merger value of acquiring company 1500. Target company 700. Number of shares of both the acquiring company and target before merger is same. So I'm taking 100. Synergy gain from the merger is 300. So synergy gain from the merger is 300. What is the value of the merged entity? What I don't know is what is the exchange ratio. What I don't know is what is the exchange ratio. But one thing I know is number of shares issued into the post merger price. Number of shares issued into the post merger price is equal to what? 1000, not 300. It is 1000 gross cost. That is gross cost, which is 300 plus another 700. 300 plus another 700. It's a very excellent questions. These MCQs will test your knowledge really well. 300 plus another 700. 1000 lakhs is the consideration paid. Now, what is this 1000 lakh is? Of the 2500, which is the post merger value, I give TC 1000. AC will have the balance 1500. AC will have the balance 1500. The AC shareholders were holding 100 shares. TC were holding 100 shares. AC was holding 100. TC was also holding 100. For them, 100 will continue to be 100. They are not going to be given anything extra. They are not going to be given anything extra. So if 100 is equal to 1500, what is that question mark which will give 1000? 100 equal to 1500, question mark equal to 1000. In short, your post merger is 166.67. Post merger is 166.67. I'll explain again. First company had a value of 1500. Second company had a value of 700. Put together the value is 2500. First company had 100 shares. Post merger, their shareholders will continue to have only 100 shares. Their shareholders will continue to have only 100 shares. Second company, instead of 700, we have paid what? Extra 300. Extra 300. Why did we pay and all? We are not discussing. Extra 300 is paid. So of the 2500 post merger value, 1000 goes to the other guy. Balance 1500 is left with me. Balance 1500 is left with me, which is equal to my 100 shares. Original 100 shares. That 1500 which is left over, it's like this: 1500 is equal to 100. 1000 is equal to question mark. 1000 is equal to question mark, which is 66.67. So exchange ratio agreed is 66.67 is to 100. 66.67 is to 100. I've done the calculation some other way, but broadly the same concept. Broadly the same concept. This is again an excellent question to test your concept. Testing the concept is what is very critical. Think and let me know the answer to this. You should be in a position to do this. Approach to formula. Please use the approach to formula. Give it a try. Nothing for you to look at in concept book. Please see it's there in the screen. Do it from there. Nothing for you to see in the concept book. If whatever I've explained you've understood, you'll be able to do it. Otherwise, you'll get stuck. Got the 100 and okay. ठीक है. AC is 540, 30 lakh shares. TC is 90, 18 lakh share. Merged is 540 plus 90 plus 45. 540 plus 90 plus 45, which is number of shares is 30 plus extra 18 into 1 by 3 plus extra 18 into 1 by 3, which is 36. Post merger price 675 by 36. How much? Consideration paid is number of shares issued into post merger market price. Number of shares issued into post merger market price. Number of shares issued is 6 lakh. Post merger market price is 18.75. 6 into 18.75. Again, I'm repeating, if somebody wants to understand crux of this chapter, concept 2, 3, 4 and their MCQ is sufficient. As long that's the crux analysis. So for problem solving, I need to explain other things. Any doubts on this? As I have talked about, the NPV of the merger is whatever is the gain from merger. From there, you subtract the true cost of merger. This could be through cash consideration. This could be through stock consideration. Doesn't really matter. Any doubts on this? To summarize, first thing is there is a gain from merger. What is gain from merger? Value of merged firm is more than the value of company A plus B put together. Value of company A and B put together. That gap is called merger gain, which can be because of synergy, which can be because of operating synergy or financial synergy. Operating is at PAT level, financial is at P multiple level. It can be gained anywhere. It can be on the new, that is the starting part or the in between part. Now this gain will have to be shared by two people, AC and TC. For TC we give consideration. Consideration can be in two forms, cash or stock. Cash is cash paid per share into number of shares. Stock is number of shares issued into the post merger market price, into the post merger, not the pre merger, into the post merger market price. Once that is calculated, number of shares issued into the post merger market price, once that calculation is done by you, then you need to move to the next step, which is calculating the net cost. What is net cost? Is true overall cost, gross cost minus the pre-merger value of target company. Logic is very simple. For a 200 lakh company, you're paying 300. So extra paid is called true cost. Extra paid is called true cost. True cost compared with the gain from merger will give you the NPV of merger, or gain for the second gain for AC shareholders. Gain for the AC shareholders. Okay, listen. Sometimes what will happen is I'm going to acquire the other company. Moment I acquire the other company, there's a possibility that the growth of the other company will change. The growth of the other company will change. And practically, growth is a very important metric in valuation of a company. If growth increases, Gordon's model will give a very high valuation for the company. Gordon's model will start giving a very high valuation for the company. Just to give an example, cash flow of company A is 40 lakh. Expected cash flow of company B is 80 lakh. Valuation of company B today is 800 lakh, and it is likely to grow at what? 10%. Okay. So the formula which we normally use for Gordon is value is equal to CF1 K minus G. So today I'm talking about company B, okay? Talking about company B. Today the company B value is 800. Expected cash flow is 80 divided by KE. Growth rate is 10%. If you do interchanging and all, KE will turn out to be 20%. KE will turn out to be 20%. But now the benefit is they are saying post merger company B will grow at 15%. That is, there could be two businesses, business A, business B, to have merged together. But this business will grow at what rate? 15% will grow at 15%. If that happens, my valuation will go up significantly. My valuation will go up significantly. How will it go up now? It is going to be 80 divided by KE remains 20, and this is 15%. This is 15% because many students in their mind think that growth increases, KE will increase. KE does not increase because of growth. Growth and KE has no linkage at all. Reason for the formula could be that way, but KE depends on the risk of the company. If risk remains same and you are growing more, price will start going up. Price will start going up. So here they are saying what is the revised value for business of company B? The revised value will significantly go up. Will significantly go up. Reason for it going up is very simple. Earlier we were growing at what rate? 10%. Now we'll grow at 15%. Gordon's model will give a high valuation. In this example, company B value from 800 will go up to 1600 when you calculate the post merger valuation. When you calculate the post merger valuation, company A nothing is given. They have not given any data on company A. Doesn't really matter. Doesn't really matter. You'll understand this now when I'm going to do a question. But whenever growth changes, there is going to be significant impact on the valuation. There's going to be significant impact on the valuation. Reason is very simple. Market likes company which grow at a very healthy rate. That's what Gordon has factored in his model. Let's come to question 12. Company Alpha, again nothing much for you to write. If there's something to write, I'll explain you. Is considering to acquire company Beta. The data of the two companies, PAT, number of shares, EPS, market value, P multiple, some order up and down it has happened. We'll put it in our order. We'll put that in our order. Company Alpha is considering to acquire company Beta in proportion to the market value per share. That is, base value is 60 is to 15. Exchange ratio is 15 is to 60. There are three scenarios which can be possible. It can be P multiple of 7.5. It can be P multiple of 15. And third is weighted average, which is what I want to explain. The weighted average part is where I'm going to explain a little bit. Again, I don't want you to write because I'm going to quickly just add in Excel. Everything will automatically come there. So in Excel, what I'm going to do is particulars. What is the first company name? Alpha. Second company Beta. Merged 1. There are three separate situations. Merged 1, merged 2, merged 3. Let's put the data given in R format. What is the PAT given? 40,000, 8,000. Number of equity share 10,000, 4,000. EPS 4, 2. P multiple 15 and 7.5. MPS 60 and 15. Number of equity share 10,000 and 4,000. Market value is 6 lakh and 60,000. First scenario, 40 plus 8 will become 48. 40 plus 8 will become 48. Number of shares is 10,000 plus 10,000 plus. What is the exchange ratio basis? EPS, which is 60 is to 15, became 15 is to 60. Became 15 is to 60. So the exchange ratio is 1 by 4. Exchange ratios. So plus 4,000, 11,000. Okay. I'm going to do many decimals in EPS, but in exam, it can lead to some rounding of gap. Okay. 4.36. I'm increasing the number of decimals. P multiple in first situation is how much? First situation is 7.5. Second situation 15. Third situation, they have asked weighted average. What is weighted average? I'll give you the formula in some time, but I'll explain the logic. So NPS is going to be 32.73, 65.45. Number of shares is 11,000. 11,000. Value is nothing but pat into P multiple. Value is nothing but pat into P multiple. Now, after this, what you need to do is, this is for your requirement, impact on wealth. What is impact on wealth? Pre-merger market price, post-merger market price, gain or loss per share, pre-merger number of shares, and overall gain or loss. That calculation needs to be done for situation 1, situation 2, and situation 3. Now, the concept which I'm going to teach is weighted average. Concept which I'm going to teach is weighted average. What is weighted average? Is somewhere between 15 and 7.5, this has to sit. Is there any synergy gain at PAT level in this question? No. Any synergy gain is either at PAT level or at P multiple level. PAT level, no gain. P multiple weighted average means no gain. Weighted average means no gain, which indirectly mean 6 lakh 60,000 will become the overall value. 6 lakh plus 60,000 will become the overall value. I'll give the logic of the formula in some time. 6 lakh divided by, so P multiple is overall value divided by PAT. PAT into P multiple. PAT into P multiple is 6 lakh 60. PAT into P multiple is 6 lakh 60. So the weighted average is 13.75. I'll give the formula in some time. This I could explain because there was no PAT level gain. There can be a PAT level gain also. There can be a PAT level gain. If there's a PAT level gain, no P multiple gain, valuation can increase. Valuation can increase. Now, what is the formula? We are going to do weighted average. We are going to do weighted average. What is weighted averages? PAT of AC into its P multiple. PAT of AC into its P multiple. PAT of TC into its P multiple. PAT of AC into its own P multiple. PAT of TC into its own P multiple. Basically, for 15 and 7.5, the weights are 40 and 8. The weights are 40 and 8. PAT of acquiring company into its P multiple. PAT of target company into its P multiple divided by PAT of AC plus PAT of TC. Divided by PAT of AC plus PAT of TC. 40,000 into 15, 8,000 into 7.5 divided by 40,000 plus 8,000. This is the formula for weighted average. This is the formula for weighted average P multiple. Everything is there in concept book. Just be in listen mode. When I tell you to write something, write it. Otherwise, be in listen mode. So 40,000 is the PAT of the first company. What is P weighted average? Is taking a weighted average of, not a simple average. Simple average is 15 plus 7.5 divided by 2. For 15, the weight is 40. For 7.5, the weight is only 8. So when you do weighted average, the answer is coming closer to 15 because that has more weights. That has more weights. Now, just to explain this with another example, then I come back to this question. P multiple of a merged firm, weighted average P multiple, combined P multiple to justify merger. What is combined P multiple to justify merger? I'll explain later. In case the problem is silent, post-merger P multiple would be equal to pre-merger P multiple of acquiring company. Consistently, we are doing this. Weighted average P multiple, if you want to calculate, PAT of AC into ACP multiple, PAT of TC into TCP multiple, divide by PAT of AC plus PAT of TC. What is the third part? I'll explain later. Now you tell me the weighted average for this. There are numbers in front of you. Tell me the weighted average. Please do calculation. Twenty into 25 plus 40 into 50 whole divided by 25 plus 50 whole divided by 25 plus 50. 33.33. Whatever the answer you get, that's called weighted average. That's called weighted average. You're doing a weighted average of 20 and 40. You're doing a weighted average of 20 and 40. Any doubts on this? Any doubts on the concept? Assume P multiple becomes weighted average. There is no gain at PAT level. You will have zero gain from the merger. You will have zero gain from the merger. Merger is not going to give any gain. Merger will not give any gain. Any doubts on this? Now, ICI in the recent 3-4 attempts have started asking one extra add-on called as you are holding the shares of target company. You're holding the shares of target company. I announce a merger. I announce a merger. Moment I announce a merger, the question will ask you to analyze and tell whether should you continue to hold the shares of this company or sell its holding. Sell its holding. This is one requirement which they have added on the recent exams. In most of the exam questions, they have added this. Now, what concept says is if I'm gaining or losing at a market price, if I'm gaining or losing at a market price, if I'm gaining at market price, continue holding. If you're losing at market price, please sell your share and say no to merger, or sell your shares and leave from the company because you're going to lose because of the merger. You're going to lose because of the merger. This approach we follow if there is no opportunity cost given. So first approach is opportunity cost of capital not given. Opportunity cost of capital not given. Compare pre-merger and post-merger market price equivalent. Gain at MPS level, continue. Loss at MPS level, sell. That's a very simple calculation. If there is an opportunity cost of capital given, that this is not a very logical thing, but ICI has added, okay. We calculate something called as earnings yield. What is earnings yield is like you have dividend yield, which is dividend by market price. Earning yield is EPS by market price. EPS by market price. That is, I am the TC shareholder. I am the TC shareholder. If merger happens, I'll be getting the equivalent earnings per share. If merger happens, I'll be getting the equivalent earnings per share divided by what is the price today. Divided by what is the price today. Why? What is the price today? Because I can sell and move out. I can sell and move out with this price. So if let's assume you do the calculation and that is more than your opportunity cost of capital or less than your opportunity cost of capital, whatever I'm going to explain, I'll explain with 2 MCQ. Things will become very clearer. Let's see now. A Limited is planning to acquire B Limited. Listen for some time, nothing much. A Limited is planning to acquire B Limited. Current share price of B Limited is 10. Same got increased by 20% on merger announcement. So 10 has become what now? 12. Post merger EPS and MPS will be 2 and 25, and the exchange ratio offered is what? I am not going to get 2 and 25. What I am going to get is 1.6 and 20.8 equivalent. Equivalent is what I get. I get only the equivalent part. What is equivalent? 2 into 0.8 and 25 into 0.8. I am not going to get the normal value. I am not going to get the normal value. 2 into 0.8 and 25 into 0.8. So I'll be getting 1 rupee 60 paise and equivalent MPS of 20. They are saying you are holding 10,000 shares and you're having another opportunity which can give you a return of how much? 12%, which can give you a return of 12%. So now you are thinking, should you continue with the company or should you sell your holding? Should you continue with the company or sell your holding? In this example, opportunity cost of capital is given. What is opportunity cost? You can earn how much elsewhere? 12%. So now write earnings yield is equal to earnings yield is equal to earning yield is equal to equivalent EPS divided by current market price. Equivalent EPS divided by current market price. What is equivalent EPS? Is 2 into 0.8. 2 into 0.8. What's the current market price after that announcement has happened? It has gone up to 12. So 12 into 100. This is the earning yield. This is not a very logical, so I'm not getting into much explanation. What is the earning yield you get? The alternative is going to give me 12%. I am telling I will continue with the company and earn 13.33%. I don't want this opportunity. I don't want this opportunity part, which is opportunity is only 12%. The opportunity part is only 12%, whereas here I can earn 13.33%. I can earn 13.33%. I'll repeat again. For decision on sale of share, two situations will be there. One very good situation, which is calculating gain or loss at market price. Gain or loss at market price level. That's the best way of doing the question. The best way of doing the question is calculating the gain or loss at MPS level and be done with it. Gain or loss at MPS level and be done with it. But some question will say don't do gain or loss at MPS level. We are giving you extra data. We are giving you extra data, which is an opportunity cost of capital. If you have opportunity cost of capital, you'll have to calculate earnings yield. You'll have to calculate earnings yield. How to do gain or loss at MPS level? I've already explained. Post merger market price, pre merger market price, gain or loss per share into pre merger number of shares, overall gain or loss. Go through 15. Go through 15. Okay. uh, Put it in the merger table format. You do it, put it in the merger table format. Everything will come. Only thing I'm going to explain is value of original shareholders. That alone I want to explain. You put this in the merger table format. I'll be back in 2-3 minutes. You put it in the format, you will get to the answers of everything. I'll explain something called as value of original shareholders. This alone starts with PBT. So PBT less tax PAT, thereafter the same thing. Start doing it. Clear? Any doubts on this? The base computation. Any doubts on the base computation? Can I proceed? Done. Let's discuss the requirements. Market value of both the company 138.6, 116.48. Value of original shareholders I'll explain. Price per share after merger is 9.5601. Effect on share price. What do you mean by effect on share price? Impact of merger on market price per share, that is post merger market price, normal for the first company, equivalent for the second company. Deduct the pre merger market price, get the gain or loss per share or impact per share. That is, for example, MPS post merger, first company is 9.56, second company is 9.56 into what ratio? 5 by 8. Pre-merger 6.93 and 7. Gain per share, okay, there is one party having a loss, and you can also calculate this in percentage. I say this question alone did percentage. What is percentages? Whatever gain on your base price. Base is the original price. Base is the original price. 37% and 7%. 37% one party is gaining, 7% other party is losing. So this merger is not a good merger because the synergy gain, the ratio in which they have distributed is wrong. Now in this question, the merger has a gain of this minus the individual values. 33.92 crores. That is the merger gain. Why did this merger gain happen? Because of the P multiple. Because of the P multiple, 11 and 8 average we have taken as 11. 11 and 8 average we have taken as 11. Now, what is original shareholder calculation is assuming merger passes through, and instead of this becoming this, it becomes 138 plus 116. It becomes 138 plus 116. That is, in the merger, the synergy gain does not even come. In the merger, the synergy gain does not even come, which is possible. Which is possible that you thought there is going to be synergy gain, but when the merger closed, none of them gained. None of them gained. So in that process, this 255 is the combined value of A limited and T limited shareholders. A limited and T limited shareholders. If gain happens, 299 is right. But if gain does not happen, that is called value of original shareholder. Now write value of original shareholders. Value of original shareholders. Value of AC plus TC is equal to. value of AC plus TC is equal to what is the put together value? 138 plus how much you get? 55.08. 255.08 is the value, no? 130. Is this right? What happened? Some of you look a little confused. Okay, that's okay. Rounding off, let's not worry about it. 255.08. What is value of original shareholders? Is merger has happened. Merger has happened. Post merger, what is the number of shares outstanding? Post merger, what is the number of shares outstanding? In this 31.25, 20 belong to AC, 11.25 belong to TC. 11.25 belong to TC. Tell me the value for 20. Tell me the value for 11.25. That's the value of original shareholder. That's the value of original shareholder. What this means is, in case merger gain do not come, what will be the value for both the set of people? What will be the value for? Because you have decided to give 20 and 11.25. 20 and 11.25. How 20 and 11.25 came? Post merger we have 31.25. In that AC continues to hold 20 and TC you give extra share. TC you give extra share. So the value is 55.08 divided by 31.25 into 20 into 11.25. Any doubts till this first? Any doubts on this? So what value of original shareholder mean is assuming you do not make any synergy gain. Assuming you do not make any synergy gain. Good assumption, bad assumption, let's not talk about it, but it is assuming no synergy gain comes, no merger gain comes, our combined value is going to be 255.08. Combined value is going to be 255.08. If the combined value is 255.08, a part of value will go to AC, which is 163.25. A part of value will go to TC. In short, the exchange ratio is so bad that these guys from 138.6 will increase to 163, and the other guy from 116 will decline to 91. Other guy from 116 will decline to 91. Ideally, they should have given a better exchange ratio, but this exchange ratio basically means one party is going to gain, because value of original shareholders total gain is zero. Value of original shareholders total gain is zero. Why? Because that's the assumption. That's the assumption. So if one party is gaining, it means the other party has to lose. For example, the first party will gain 163 minus, second party will lose 91 minus 24.65. One has to gain, the other one has to lose. Value of original shareholders basically assumes that none of the parties, or the overall gain is going to be zero. Overall gain is going to be zero. Why is this calculation done? Because you are saying all this will happen, may or may not happen, may or may not happen. So value of original shareholder is saying if it does not happen, what is the scenario? What is the scenario? Which is also covered in your concept book. It is this chapter, I could not cover it like the mutual fund at one place. That was not possible. So you will keep seeing me moving from one concept to the other concept. Can't help it. So value of original shareholders is value of TC is equal to pre-merger value of AC plus TC. I told you to add both the values. Divide by pre-merger shares of AC plus shares issued into the shares issued to TC shareholder, shares held by the AC shareholder. In short, the 255 split in the ratio of 20 is to 11.25. That concept is called value of original shareholders, where you may get a gain, you may not get a gain. Clear? Good morning, friends. Good morning, friends. Okay, let's continue with our revision discussion. In the last class, we were doing mergers and acquisitions, where we learned the basics of M&A, where we learned that there's a merger table which we prepare, which gives you all basic information related to a merger evaluation, starting from PAT, divided by number of equity share, you get EPS, P multiple, MPS, number of equity share, and the market value of the firm. That's a basic analysis which we do in a company. After doing the basic analysis, you will prepare a merge table In merge table, you can add the PAT of the two companies if there is no operating synergy. You get the number of shares, which is shares of AC plus the shares issued to TC. Shares issued to TC depends on an exchange ratio, which would be given in the question, or the basis would be given. If the basis is given, you will have to swap the basis, get the number of shares issued, add the number of shares, get the EPS. P multiple you can copy paste of AC, or they can give a P multiple, or it can be a weighted average. Weighted average is PAT of AC into its P multiple, PAT of TC into its P multiple, divided by PAT of AC plus PAT of TC. That's the weighted average we do. We use that as a P multiple and then complete the MPS, market value of firm. This is one part of the analysis which we did. Then there were certain extra add-ons we learned. One is called gross cost of merger, net cost of merger, and NPV of merger. What is gross cost of merger? Is consideration paid, which is cash paid per share into number of equity share, or number of shares issued into the post-merger market price. Number of shares issued into the post-merger market price. Net cost of merger or true cost of merger is equal to gross cost of merger minus pre-merger value of target company minus the pre-merger value of target company. You will have to just subtract the pre-merger value, and NPV of a merger is equal to gain from the merger minus the true cost of merger. Whatever is the gain from the merger, subtract the true cost of merger. These are the broad things we learned. Today I'm going to first start with an area called as minimum exchange ratio and maximum exchange ratio. Now, just give me a minute. Point number 1 is done, 2 is done, cost of merger is done, NPV is done. Okay, I'll keep discussing this. Post merger EPS, that is, how do you calculate post merger earnings per share? There are two situations for calculating post merger EPS. One is share consideration, second is cash
Sir,
consideration. Yeah,
your voice is breaking, sir.
voice is
Sir,
breaking.
your voice is breaking, sir. Sorry.
So your voice is breaking. Sorry.
Okay, just give me a minute. Okay,
Thank you, sir.
so what I was explaining is the post merger EPS, what we calculate can be under two situations. One is stock consideration, cash consideration. Stock consideration, if you pay, the merger table itself will give you the data. What is merger table going to do? It's going to combine the PAT of two companies, add if any synergy gain is there, add if any synergy gain is there, divided by number of shares of AC plus the shares issued to TC. This is if you do a stock offer. If you do a cash offer, what happens is there's a PAT of AC, add PAT of TC, AC and TC. Denominator will be shares of AC alone. TC shares will not come. TC shares will not come because in a cash offer, I am not going to allot any extra share. Then it will be a huge benefit, but there's one disadvantage, minus interest cost or opportunity cost. Sorry, yeah.
Games.
Sorry, again, are you facing an issue?
So your voice is breaking.
Again,
Yes, sir.
I don't know. Change the internet also.
Yes.
Please go on mute. Shruti, please go on mute. Okay, so there's a PAT of AC and there's a PAT of TC. Along with that, there is something going to be interest cost. What is this interest cost? Is when you pay a cash consideration, you'll be paying 1,000 lakhs, 2,000 lakhs. This 1,000 lakhs you may borrow. You may borrow. If you are borrowing, you will pay interest cost. If you are borrowing, you will pay interest cost. Assuming you did not borrow, you had surplus money. You had surplus money. If you had surplus money, you lose interest income on that 1,000 lakh. You lose interest income on that 1,000 lakh. So one of the two can happen. Either you incur interest cost or you lose interest income. You incur interest cost or you lose interest income. One of them can happen. An example, earnings of target company 75 lakhs. Acquiring company plans to give cash consideration which will be funded with 15% loan. Tax rate is 30%. What is the maximum consideration payable so that the overall EPS of AC is maintained? So that the overall EPS of AC is maintained. Listen, EPS will be maintained if PAT of AC divided by this is before merger, After merger, I want the same thing to happen. That is PAT of AC divided by pre-merger number of shares should be the final EPS. They have not given data on AC. When can this match? If PAT of target company and this is 0. When you add and subtract, it becomes nil. When you add and subtract, that is PAT of acquiring company, let's assume is 1 crore. 1 crore. This will go up by 75 lakh and minus 75 lakh is the interest cost. Minus 75 lakh is the interest cost. Your numerator will continue to be 1 lakh. Numerator will continue, sorry, 1 crore. Denominator will continue to be the same number of shares. In short, EPS can get maintained if your interest cost on a loan is equal to profit after tax of target company. Clear? Any doubts on this? We'll see this in a question later. Okay, I said I'll discuss this in the class. Combined P multiple to justify merger. Now, what is combined P multiple to justify merger is, let's assume you are planning to merge A and B. You're planning to merge A and B. A merger is justified. A merger is justified if at least combined entity has this value 255.08. I don't want anything extra, but I don't want anything less also. I don't want anything extra, but I don't want anything less also. Minimum 255 crores I want. Minimum 255 crores I want. If I'm able to get minimum 255 crores, a merger is justified. A merger is justified if I get minimum 255.08 crore. More than that, merger is very good. Less than that, merger is not possible. Now, they are saying what should be the P multiple so that the merger is justified. For that, let's assume this extra 3 crore synergy gain is there. Just assumption, okay? Extra 3 crore synergy gain. So, what should be the P multiple to justify the merger is very simple. Value of AC plus value of TC divided by post-merger earnings. Divided by post-merger earnings, because PAT into P multiple is the value of the company. PAT into P multiple is the value of the company. So, balancing figure is 8.4576. 8.4576. 11 and 8 weighted average is not 8.4576. Here there is a PAT level gain. There is a PAT level gain which has happened. Because there is a PAT level gain which has happened, minimum P multiple I want 8.4576. This is minimum to justify the merger. Anything better, I'm very happy. Anything weaker, I'm not happy. It is not equal to weighted average P multiple. It can be equal to weighted average P multiple if there is no PAT level synergy gain. If there is no PAT level synergy gain. Example, earnings of A Limited 20 lakh, P multiple of A Limited 10 times, which means the value of A Limited is 2 crore. The value of A Limited is 2. Nothing for you to refer in your notebook. Please keep referring the screen. 2 crore is the earnings of value of A Limited. B Limited 40 lakh and 7.5, which is 3 crore. Now, put together, merged should have a value of at least 5 crore. Put together, the merge should have a value of at least 5 crore. 5 crore divided by the post-merger PAT. What is the post-merger PAT? 20 lakh plus 40 lakh plus 2 lakh 50. So, 5 crore divided by 62.5 lakh is the minimum P multiple I want. Minimum P multiple I want to justify the merger. Minimum P multiple to justify the merger. Anything better is always good. Anything better is always good, but minimum I want is this. What is weighted average P multiple? Weighted average P multiple is PAT of AC into its P multiple, PAT of TC into its P multiple divided by PAT of AC plus PAT of TC. No adding synergy gain. No adding synergy gain. In this is the minimum P multiple I want to justify a merger. Equivalent EPS discussed, gain or loss discussed, exchange ratio discussed. Okay, minimum and maximum exchange ratio. First, I'll explain the concept and then I'll do it in the problem. I'll do it in the later part. First 30 minutes, let me quickly close all the concepts. Then together doing problem is easier for me. So let's assume okay, this is a mark and mask limited problem which we had done in the last session. Value of mark was 20,000, mask is 2,000. merged is 24,000. Minimum consideration is always from a seller's point of view. For example, I want to sell this building. In my mind, I have one thing, that minimum how much I want. Minimum how much I want. Anything more than that, I'm happy. But there is a minimum which is there in my mind. Maximum is always from a buyer point of view. When you go to a shop, you have decided that you will pay only 1,000 rupees for this product, nothing beyond that. You will try to negotiate. 1,000 can become 900, 800, 700. You are very happy. But you have in your mind that maximum I'll pay is this much. So buyer will always have a maximum and seller will always have a minimum. In short, AC will have maximum ER in their mind. TC will have minimum ER in their mind. Minimum consideration, if you are the seller of Mask Limited, you will say minimum give me 2,000. Minimum give me 2,000 because that's my value today. That's my value today. So minimum consideration is equal to pre-merger value of target company. Pre-merger value of target company. What is maximum consideration or maximum exchange ratio is? Maximum consideration is Mark is saying today my value is how much? 20,000. Because of merger, my value becomes what? 24,000. So he is saying in his mind, okay, 20,000 is becoming 24. I can pay extra 4,000 to the other guy. I can pay extra 4,000 to the other guy. That extra 4,000 is called maximum consideration. That extra 4,000 is called maximum consideration. At maximum consideration, AC share of gain is 0. If you pay the maximum amount, AC will not gain anything. If you pay the minimum amount, TC will not gain anything. If you pay the minimum amount, TC will not gain anything. If you fix in between, both will be very happy. Both are going to be very happy. Again, I'll repeat. Minimum consideration always seller wants. Seller wants. I have in mind that minimum 2,000. I will start with saying that I want 6,000. Then maybe bring it to 5, 4, 3 negotiation. But when it starts touching 2,000, no, I'll say I walk out of the deal. I cannot go below 2,000 and all. I cannot go below 2,000. Minimum give me 2,000. Anything more you give, I'm happy. But minimum 2,000 I need. So minimum consideration is pre-merger value of target company. Pre-merger value of target company. Maximum is nothing but value of acquisition. What is value of acquisition is 20,000 becoming 24,000 is the benefit or value of acquisition. Benefit or value of acquisition. The formula is post-merger value of AC minus the pre-merger value of AC. Post-merger value of AC minus the pre-merger value of AC. Extra 4,000. Extra 4,000. I can afford to pay this to you. I can afford to pay. Will I pay? I'm not talking about that. That is the maximum I can pay. Let's negotiate, discuss, decide where you want to end up. Clear? Any doubts in this? Maximum ER is from the point of view of acquiring company. This should lead to acquiring company making no profit at MPS level. Zero profit for me. Minimum ER is from the point of view of target company. This should lead to target company making no profit. Maximum consideration, post-merger value minus the pre-merger value. Minimum consideration, pre-merger value of target company. Pre-merger value of target company. Let's understand in an example. Value of acquiring company 1,000 lakh. Value of target company 500 lakh. So I am at 1,000. These guys are at 500. These guys are at 500. Put together, where are we ending? 2,000. There's a merger gain. There's a merger gain. They're asking what is the acceptable minimum exchange ratio and maximum exchange ratio. Minimum exchange ratios, I'll pay 500. Minimum exchange ratio, I'll pay 500. That's not the exchange ratio. That's a consideration. How to come to exchange ratio, I'll explain. Minimum is 500. What is maximum you can pay? 2,000 minus the 1,000. If you pay 500, TC will say I don't make any gain. If you pay 1,000, AC will say I don't have any gain. But that's okay. That's the deal. That's the deal. How many shares are there in AC today? 10 lakh. TC? 10 plus 50 can become anything. 10 plus 50 can become anything depending on the exchange ratio. Now, how do I decide the exchange ratio? It's a slightly important calculation. Just understand this properly. Anyway, we'll do it in problem. 2,000 is the value. First scenario, I said I'll pay 500 minimum. Minimum, I'll pay 500. So, TC will get 500. Balance will go to AC. balance value will go to AC. How many shares are there in AC today? This can never change. This can never change. 1500 equal to 10. What is 500? 1500 equal to 10. What is 500? I'm going to issue 3,33,333 share. I'm going to issue 3,33,333 share. If you do 3,33,333, post merger market price into the number of shares issued will be 500 lakh. Into the number of shares issued will be 500. I'll repeat again. 2000 is the combined value. 2000 is the combined value. In that, AC is at 10. TC is currently at 50. TC is currently at 50. Put together, 10 plus 50 should become 10 plus 3.33333. 10 plus 3.33. If it becomes 13.33333, what is the share price? 2000 divided by 13.3333. 150 into 3.3333, so much. So I am paying that consideration. I'm paying that consideration. So minimum I have to allot 3,33,333. First, you have to understand what is the minimum consideration and maximum consideration. Once you have understood that, let's analyze the maximum. 2,000. In that, I'll give to TC 1,000. AC is balancing figure. 1,000. 1,000 is equal to 10 lakh. 1,000 is equal to 10 lakh. Other 1,000 is also equal to 10 lakh. So 10 is to 50 is the exchange ratio. 10 is to 50 is the exchange ratio. 50 lakh shares are there. 50 lakh shares are there. You can then calculate the ratio. Ratio calculation I'm not explaining. I'll repeat again. Minimum consideration is equal to pre-merger value of target company. Minimum consideration is equal to pre-merger value of target company. Maximum consideration is equal to post-merger value of AC minus the pre-merger value of AC. Post-merger value of acquiring company minus the pre-merger value of acquiring company. How do I decide the ratio? Write the overall value. Write what goes to TC. Balance will be with AC. That is equal to their original share. That is equal to their original share. Any doubts on this? Original shareholders we have done. Okay, free float market cap, another very important concept which many a times ICI test and students make a mistake. Now let's understand what is free float market cap first. In a practical world, there are two types of market capitalization. What is market capitalization? Is value of equity, value of equity. I have free float market cap, I have total market cap. What is free float market cap is if a promoter is holding 10% of the company, then 90% is held by public. 90% is held by public. Or so not 10%, let's assume 60%. Promoter is holding 60%, 40% is held by public. Whatever public is holding is called free float market cap. Whatever public is holding is called free float market cap. Why public holding is called free float? Because promoter cannot do buying and selling as he wishes because there are restrictions. Free float means something which can be bought and sold instantly. You bought shares of TCS today. You can sell it tomorrow, day after tomorrow, 3 days, 4 days. Nobody is going to question you. But promoter buys and sells like this, SEBI will come with a question because they have data, they have access to insider information. So promoter cannot just keep buying and selling. So free float market cap is total market cap. What is total market cap? Is this number. Market value of equity. Market value of equity into shareholding of non-promoter. Into shareholding of non-promoter. An example, free float is 400. Free float is 400. Promoter is holding 80%, which means public is holding how much? 20%. That 20% is 400 lakh. That 20% is 400 lakh. So what is the total market cap? 2000. 2000 lakh divided by 10 lakh shares is the market price. 2000 lakh divided by 10 lakh is the market price, which is 200. Any doubts on this? Any doubts on this? Again, I'll repeat. Free float means shareholding of non-promoter. Shareholding of non-promoter. An extremely important number because many questions in ICI exam has tested on this free float market cap concept. Clear? Any doubts on this? Can we proceed? Decomposing of share price. We have already done. MPS can be broken down as EPS. EPS can be further broken down as ROE into BVPS, book value per share. ROE into book value per share. If you remember the formula for ROE, it is EPS divided by book value per share. ROE formula is EPS divided by book value per share into 100, or EAES, earnings available to equity shareholder, divided by amount of equity. EAES, if you divide by number of shares, you get EPS. EAES, if you divide by number of shares, you get EPS. Book value per share, how you calculate is amount of equity. I'll anyway discuss this in a minute. Amount of equity divided by number of shares. So if I want, I can decompose like this. MPS can become EPS into P multiple. EPS can become ROE into book value per share. Let's discuss the book value per share. What is book value per share is very simple. Net worth of a company. Net worth of a company divided by number of equity share. What is net worth? Share capital plus reserves minus fictitious asset. Minus fictitious asset. Either you go through, please listen, share capital plus reserves minus the fictitious asset. Either you go through the liability side route, or fixed assets plus current assets, that is from the asset side route, subtract anything other than share capital and reserves. Subtract anything other than share capital and reserves. Again, be very clear. When you are doing from the asset side, if you start fixed assets plus current assets and don't even add fictitious asset, now don't tell me you want to subtract the fictitious asset, because you have not even added it. If you have not added it, where is the reduction from it? So fixed assets plus current assets minus your current liability, long-term debt, short-term debt, preference, anything other than share capital. So in balance sheet, you have share capital, reserves, preference, long-term debt, short-term debt, current liability. This side you have fixed assets, current assets, fictitious asset. Either consider this and subtract all of this, or consider this and subtract the fictitious asset. Subtract the fictitious asset. Can you give me answer to this? Give me the answer to this. Fixed assets is 20 plus 30, 50 minus 2 lakh minus 8 lakh. Don't subtract P and L debit balance, because we have not considered it in the asset side. I have not considered this in the asset side. Where is the requirement for me to subtract it? I don't have any requirement to subtract this 20 per share. Then this side, do this. You'll have to subtract everything from total assets. Subtract the P and L debit balance, subtract creditor, subtract short-term debt, subtract long-term debt, subtract preference. Everything needs to be subtracted, because P and L debit balance is part of the total assets. Part of the total assets. Any doubts on this? Okay. Sometimes an organization will do something called as a bonus or a split. Bonus or a split. Bonus, we understood in mutual fund that you allot extra units, and in case of a split, a 20 rupee share will become a 1 rupee share. Whatever you do, value of the company cannot change, because value of the company is PAT into P multiple and not MPS into number of equity share. PAT into P multiple. Because what happens if you do a bonus? Share price falls, number of shares go up. If you do a split, share price further falls, number of equity shares go up. So overall value of the company is going to remain same whether you do a bonus or you do a split. But yes, EPS will fall, MPS will fall, but value will remain same. Just an example. Current book value is 150. One share is 150 rupees book value. Company plans to make a bonus issue of 2:1. Today, one share 150. In bonus, how many extra shares we are going to allot? 2. So it will now become 3 shares. It will become 3 share, and each share will be worth only 50 rupees now. Each share will be worth only 50 rupees now. Then you are doing splitting 100 rupee share into 20. So you originally started with 1. 1 became 3. 3 is now becoming 60. One share was there, you made it 3 by doing a 2:1 bonus. Then you are saying you want to split a 100 rupee share into 20 shares of 5 each. 100 rupee share into 20 shares of 5 each. So 1 became 3, 3 became 60. Whatever be it, value is 150 only, value is 150, value is 150, which means per share is 150. This is 50 rupees, this is 2.5. So your 2.5 and 50 is going to be the number once you do a split and you do something called as once you do a bonus and then you do a split. Practically, organizations will do split or bonus only one reason. There are some companies whose share price will keep going up. It would have touched 2,000, 3,000, 5,000, 10,000, 15,000. So moment share price touches beyond a level, lot of retail investors stop avoiding that company. It's not that per share price matters. Reason for avoiding is my maximum budget in one share I'll invest is only 10,000 rupees. And I find in the market one share itself is 20,000. Example, classic example, MRF, whose price is around 1,50,000. You wanted to buy something with 10,000 rupees, obviously you cannot buy. If MRF does a bonus, does a split and all, this 1,50,000 may keep going down and it may reach a number which becomes easy for you to buy. That's the only purpose of doing a split or a bonus. Otherwise, it doesn't serve any purpose. And in mutual fund, it doesn't serve any purpose itself, because in mutual fund, if one NAV is 1,50,000, you can buy 1/10 of a unit. There you can buy even in decimals. So there the bonus has no utility at all. I don't know why ICI wants to. Lot of MF have removed the concept of bonus. They've removed the concept of bonus in the practical world. Doesn't serve any purpose, no, because you don't want to buy 1,50,000 worth of a mutual fund. Buy 5,000. 5,000 by 1,50,000, they'll allot the units in decimals. They'll allot the units in decimal. Okay, we analyze this minimum and maximum exchange ratio. Minimum is from the point of view of whom? Target company. Maximum is the point of view from acquiring company. This is from the point of view. But let's assume I have an option of paying 2:1 or 5:1. You have two options, 2:1 or 5:1. If you are the acquiring company, which one would you want to pay? Which one would you want to pay? Please analyze and let me know. I'm not asking how are you calculating minimum ER and maximum ER. Please listen. Okay, I'll give you different. You go to a shop, the price is 200 or 500. Which price you want to pay? 200. Which price you want to pay? 200. So the acquiring company would want to pay a lower price. Acquiring company would want to pay a lower price. You are the seller. You want to sell at 200 or 500? So seller would want maximum. See, we have just did that calculation. That is nowhere the final exchange ratio. So you did your minimum, maximum, everything is done. Now in your mind, you have two things. You did your calculation. Minimum, you wanted something. You also visualize what the other guy wanted. You did your maximum. Both the calculation is done. Now the final ER will be somewhere in between this. The final ER will be somewhere in between this. If acquiring company is very strong, that is, you go to the shop and you are the stronger person. You go to the shop and you are the stronger person. You will push him to closer to 200. You will push him to closer to 200. And if the shopkeeper is stronger, he will push you to closer to 500. So depending on who is stronger, the final ER will fix. The final ER will get fixed depending on who is stronger. Don't confuse it with minimum ER and maximum ER calculation. That calculation was done for only one purpose, saying that how much minimum I want. I came to this place, I said minimum I want to sell this for 2 crore. That is minimum, but I would want to sell it for 5, 6, 7, 8, 9, 10, whatever is feasible. Minimum I have in my mind. Minimum I have in my mind. So the ultimate exchange ratio during negotiation is contingent on the strength of the involved company. If the acquiring company is stronger, that is, the buyer is stronger, you go to a shop and if you are stronger, the final ER will be closer to 200 rupees. The final price will be closer to 200. If the target company is stronger, the final ratio will be closer to upper limit. How do you find who is stronger? Who has better ROE, who has better P multiple, who has better market share, who has better brand strength? Based on that, you decide who is stronger and then decide the final exchange ratio. I'm not going to decide the exchange ratio. I'll only answer saying where it is going to be, because one question tested this. Will it be closer to the upper limit or the lower limit? Clear? Any doubts on this? This we have done. Intrinsic value. Now let's understand what is intrinsic value. Intrinsic value means real value of a company. Intrinsic value means real value of a company. For example, you went to a shop. You wanted to buy some product. You have no idea on the product price. He says market price is 200 rupees. That is intrinsic value. Whatever is the market price is the intrinsic value. Sometimes you may have a judgment about the price. You can say this laptop should be only 45,000. Real worth, according to you, what is the real worth of the laptop? That is called intrinsic value. If you have no idea, market price is the intrinsic value. Market price is the intrinsic value. Why market price is the intrinsic value? Because market price is determined by 1 lakh, 2 lakh, 5 lakh investors. So many people are doing buying and selling, and they are determining the price. So when so many people are determining the price, that's a fair price. That's the fair price. But you may decide that something else is intrinsic value depending on the data in the question. Example, A Limited is planning to acquire B Limited. Market price of A and B is 40 and 20, but A Limited is saying intrinsic value of B Limited is how much? 30. Price is 40 and 20, but the intrinsic value according to you is 30 rupees for the other company. What should be the exchange ratio on the basis of intrinsic value? For intrinsic value, I have to write base value. Base value is acquiring company is to target. Target intrinsic value is 30. Acquiring intrinsic value due to lack of information is the market price of 40. If they give some data on intrinsic value, please write intrinsic value is the real worth. Intrinsic value is the real worth of a company. Any doubts on this? This is okay. This I've already discussed in some other way. Okay, this is a very important thing. Exchange ratio based on adverse parameter. Now let me first give an example. Let's assume there are two banks which are going to be merged. You will see this problem later on. Bank 1 has an NPA of 20%. Bank 2 has an NPA of 40%. 20 and 40. Which is better in this? 20. So base values you wrote 20 is to 40. If you swap, it will become 40 is to 20. By swapping, you are saying if you have bad NPA, I'll give you more shares. By swapping, you are telling the other company that you increase your NPA percentage, I'll give you more shares. You increase your NPA percentage, I'll give you more shares by doing swapping. So if there is any adverse parameter, what is adverse parameter? Adverse parameter is nothing to do with the value of A and B, because some students thought AC and TC value we have to compare and then see which is adverse. Adverse means something which you want to minimize. EPS. Do you want to minimize EPS or maximize EPS? MPS. Book value per share. Loss. So let's assume the basis is loss. If the basis is loss, write the base value, and that's the exchange ratio. No swapping. No swapping is needed if you are doing any adverse parameter. If you swap, what happens? If you swap an adverse parameter, you are basically telling you do bad performance, we'll give you more shares. So adverse parameter refers to the aspect that a company aims to minimize or reduce. Example, NPA, expense ratio, COGS ratio. In this case, the exchange ratio will be same as base value and no switching needs to be done. Some student unfortunately have understood this, saying that I'll compare A and B value. If MPS of A is better than B, it is favorable, otherwise it is adverse. Nothing that. I am very clear in my example. An adverse parameter basically mean something which you want to minimize. If there is something which you want to minimize, that is an adverse parameter. Let's be very, very clear. Don't try to tell me anything different there. If you want to minimize something, it is an adverse parameter. Example, NPA of bank A 40, NPA of bank B 20, number of shares of bank A, B is acquiring A. So 20 is to 40 is the base value, and exchange ratio is also 20 is to 40. These are ratios related to bank merger. One is gross NPA percentage. How you calculate gross NPA percentages? Whatever loans you have given, bad loans divided by total loans. Bad loans divided by the total loans. Capital adequacy ratios, net worth divided by risk weighted assets. Net worth divided by risk weighted assets. Now this can help you somewhere to do weighted average. Weighted average is the most important part. Let's understand. Net worth of bank A is 100. Its capital adequacy ratio is 16. Net worth of bank B 200. Capital adequacy ratio 6. What is the capital adequacy ratio of the merged bank? Will be somewhere between 16 and 6. Will be somewhere between 16 and 6. So how do I calculate? Net worth, risk weighted assets, capital adequacy ratio. Net worth, risk weighted assets and capital adequacy ratio. What is the net worth of the first bank? 100. What is its capital adequacy ratio? 100 divided by something is 16. What is that divided by something? Do inverse and let me know. 6, 625. Then the second bank. Net worth is how much? 200. Capital adequacy ratio 6%. Risk weighted assets 3000. For merge, 100 plus 200 became 300. 625 plus 3333 became, get this, 7.58%. 7.58%. Its weighted average, I don't know, many students have faced a lot of difficulties in properly doing the weighted average. So it's very, very clear. Be crystal clear in your calculation. Very crystal clear. The formula can be changed the way you want. The formula can be changed the way you want. Second example, advances of bank A 1000. GNPA percentage is 20. What is GNPA percentage? Is 20% is bad. 20% is bad. Bank B, they have not given the percentage, they have directly given the bad loan, which is 100 lakh. Finally, somewhere weighted average needs to be done. Weighted average needs to be done. DuPont framework for computing ROE. Again, something which you could have learnt at inter level. ROE, what is the formula I said? EAES by amount of equity. EAES by amount of equity. If you divide EAES by number of equity share, you get EPS. And if you divide amount of equity by number of equity share, you get value of equity. What is amount of equity? Share capital plus reserves minus the fictitious asset. This EAES can also be called as PAT. So now what happens is PAT divided by sales. I'm breaking the formula further. That is what DuPont did. PAT by sales. Sales goes to the top. Sales by asset. Asset goes to the top. Divided by equity. So PAT by sales is called net profit margin. Sales by asset is called asset turnover. And asset by equity is called equity multiplier. Asset by equity is called equity multiplier. When you multiply all the three, you will get return on equity. You will get return on equity. There's an example which you can see later. Okay, next is bonus issue to reduce promoter holding. I'll directly explain the concept. What they are saying is promoter is holding 90% or 80% of the company. SEBI suddenly says you'll have to bring this down to 75, 70, 65, some number, because there is some maximum holding you can have. Some SEBI put some restriction. So what they are saying is promoter, to reduce his holding, will give free shares only to minority shareholder. Will give free shares only to minority shareholder. Publicly, nobody is going to do this, because if my holding is higher, I will sell my shares and get some money. Why will I give free shares to someone else? Why will I give free shares to someone else? Promoter holds 90% of the company. Here they are planning to give bonus to minority, so that shareholding comes down to what? 75%. Let's assume today you have 100 shares. In that, promoter holds 90%. Now suddenly they are saying this 90 will continue, but promoter should hold only 75%. If 75% is equal to 90, what is 100%? 1, which means extra 20 lakh for 10 lakh minority shareholder. Extra 20 for 10. What is 10? 100 minus 90. Today, 10 shares are held by minority. I'm calling them, telling them I'll give you free shares. I'll give you free shares. So the problem is when you allot bonus only for one people, share price will fall for everyone. The other guys are happy because when price fell, their number of shares went up. Promoter price falls, number of shares do not go. Number of shares do not go. Bonus is not a problem if you give to everyone. If you give to everyone, you cannot randomly say that I'll give bonus only to this people. I don't know why this question was there, but it has come 2-3 times in exam. It has come 2-3 times in exam. So bonus is very simple calculation. What we are trying to do here is we are saying we're calling the minority guys, telling them that I'll give you free shares. I'll give you free shares. What is the purpose of free share? So that your holding goes up. Your holding goes up, my holding comes down. Any doubts on this? So 20 lakh extra, 20 extra. What is 20 extra? 100 becoming 120 for 10 shares. What is 10? 100 minus 90. So bonus ratio is 2:1. Minimum consideration for promoter to relinquish promoter holding. I explained sometime minimum consideration. What is the formula for minimum consideration? Pre-merger value of target company. So that is 2000. At a per share, it was 20 rupees. At a per share, it was 20 rupees. Assuming he wants to give you cash. You said, give me 20 rupees. Promoter is saying, I don't want 20 alone. Give me something extra. Why something extra? Because sometimes what can happen is promoter can exploit the company. An example of exploitation is I am the promoter of the company. What I did is I was paying higher MD remuneration to myself. I was paying higher MD remuneration to myself. What is the effect of higher MD remuneration? EPS went down, price went down, EPS went down, and price went down. So somebody wants to acquire my company. I'm a minority shareholder. I'm a minority shareholder. I just say, give me 20 rupees. Give me 20 rupees. But I'm not a minority shareholder. I'm the promoter. So I'm saying, give me 20 rupees and give me this consideration, that extra remuneration I was getting. I lose this now. I will lose this now. You give me this also. You give me this also. It is unethical, but they were exploiting it. They were exploiting it. So whenever a promoter wants to sell his business, he will not agree with that minimum price. If he has exploited, if he has not exploited, minimum is sufficient. Minimum is, that is minimum. I'm not saying that will be the final price. That will be the final price. An example, current market capitalization is 40 lakh. Number of shares of the company is 1 lakh, which means today price is, if I am a minority shareholder, give me 40. I'm very happy. Just give me 40 rupees. Then they are saying promoter and their family members are part of top management and are currently overpaid. They have received excess remuneration of 2 lakh per year. Every year they have been receiving 2 lakh extra. In future also they will receive it. Whose present value is how much? 15 lakh. So what this guy is saying, give me 40 rupees and give me extra 15 lakh rupees. Give me extra 15 lakh rupees. How many shares promoter is holding today? Number of shares. 40,000. So 15 lakh divided by 40,000. Extra you have to give me. So my minimum is 77.5. Minimum is 77.5. What he is saying is, I want only 40 rupees. But because I'm exploiting the company, can you give me something extra? Because I'm exploiting the company, can you give me something extra? You will see all of this in one or the other question as we proceed. Decision on sale of shares is discussed. I'll explain this concept. This is a slightly complex concept. Listen, there is a company 1 which is making a profit of 100. Company 2 is making a profit of 200. This will grow at 8%. This will grow at 10%. So next year it will become 108. This will become 220. They're saying merger is going to happen. Because of the merger, the growth will be 15%. So ideally what should happen is, combined is 300, growth is 15%. Next year should be 345. But instead of this happening, next year can be total of this itself. Only for 1 year. Instead of growing at 15%, you may grow at 8 and 10 of the individual PAT. Why will this happen? Every company which is growing, if I have to grow in the next year, I have to do investment today. So a merger is going to happen. AC is going to acquire TC. Merger happens. but before the merger was getting concluded, they've already done the investments for the next year. They've already made the investments for the next year. So merger will happen, growth will be 15%, but if you have already made your investments, if you have already made your investments for the first year alone, it will be 8 and 10% growth only. It will be 8 and 10%. What can happen extra on top of this? If at all some synergy gain is there, extra on top of this, some synergy gain can get added, but instead of growing at 15%, you will grow only at the historical growth. What will happen in the second year? 328 plus 15, third year plus 15, fourth year plus 15, because next year onwards you would do investment and next year you can grow at 15%. And if you remember, for growth there's a formula called ROE into retention ratio. ROE into retention ratio. So if you had retained more and invested more, then only growth can change. So if you want to grow more, maybe you have to retain more. You have to retain more, which unfortunately March got over, investments already done. So next year 2024-25 alone, you will have an impact of past growth. In future you can keep growing at the higher rate. You'll understand all of this when you see a problem. An example, last year earning of acquiring company 100 lakh, growth rate is 10%. Last year earning of target company 50, growth rate 6%. Synergy gain due to merger is 10 lakh, and the likely growth rate post merger is 12%. In case this line was not there, the companies have just paid dividend and retained earnings have already been reinvested. If this line was missing, what was the last year PAT of AC? 100. TC 100 plus 50, 150. What is the synergy gain? 10. 160, add 12% on that. In case that line was missing. In case that line was missing. But they are saying already everything is done. Already reinvestment is done. So 100 will grow at 10%. 50 will grow at 6%, and an extra 10 lakh will come because of synergy gain. An extra 10 lakh will come because of synergy gain. Where will this have an impact? This will have an impact because you'll be doing Gordon's model of valuation. You do Gordon's model of valuation. Second year onwards, whatever you made in the first year, add your growth rate. Whatever you made in the first year, add the growth rate. 29 is a very simple. 29, 30, 31. 31 I'll explain with the question. 32 is an illogical component. I'm not discussing it. 29, 30 you will be able to understand. You'll be able to understand. Now I'll get into some questions discussion. Any doubts, any concept you have a doubt, let me know. Anything you want me to explain again, concept part, any concept you want me to explain, let me know. Else I proceed to the problems. Any concept. Okay, let's assume I have decided that I want to acquire a company. I've decided that I want to acquire a company, but it could be possible that I don't want to allot share. I don't want to allot share. Then what is the choice I have? I have to give them cash. But for giving them cash, I need to have cash in my balance sheet. I need to have cash in my balance sheet. So a question may ask, how much fund is available to merge a company? How much fund is available for merger? Now, how do I calculate this? Let's understand this. A Limited has an equity capital of 2 crore. Both A and T have arrived at an understanding that debt equity ratio should be 0.3:1 of the merged company. Pre-merger debt in A is 20 lakh, T is 10 lakh. How much is my equity capital? 2 crore. My debt equity ratio has to be 0.3:1, which means I can borrow 0.3 into 2 crore. I can borrow 0.3 into 2 crore, which is 60 lakh, which is 60 lakh. In that, already I have debt of how much? 20 and 10. Why this 10 is also relevant? Because when you merge, you would have to take over that. You will have to take over that. So you can borrow 60 lakh. You can borrow 60 lakh. In that, you have already borrowed how much? 30, which means extra 30 lakh can be borrowed. Extra 30 lakh can be borrowed. Apart from that, you have how much? 40 lakh cash is there. 40 lakh cash is there. So I have total 70 lakhs to acquire that other entity. I have total 70 lakhs to acquire the other entity. Now it could be possible that I acquire that other entity for 50 lakh. Merger possible. 80 lakh. Merger not possible because I do not have liquidity. I do not have liquidity. What we are trying to calculate is how much is the fund available fund available for merger. Okay, nothing much for you to go through. Be in listen mode. I'll keep explaining. You will understand it. First thing is format for doing merger analysis. We start with PAT divided by number of equity shares, EPS, P multiple, MPS, number of equity share, market value of firm. Gain from merger is equal to market value of the merged firm minus the sum of A plus sum of B. Why will it happen? If PAT is better, cash flow is better, P multiple is better, cost of capital is better. What is cost of merger? There are two types, gross cost and net cost. Gross cost is equal to cash paid into number of shares or shares issued into the post-merger market price. Shares issued into the post-merger market price. What is net cost? Gross cost minus the pre-merger value of TC. This is equal to gain of TC shareholders. You can participate along with me. Gain of TC shareholders. The leftover is the NPV or the gain of AC shareholders. NPV or the gain of AC shareholder. What is the EPS post merger in case of a stock offer? PAT of A, PAT of B, any synergy gain divided by number of shares of AC plus shares issued to TC. In case of a cash offer, PAT of AC plus PAT of TC minus interest cost or interest opportunity cost divided by only shares of AC. No extra shares, no extra shares. How do you determine exchange ratio? Some bases will be there. Write their base values, do switching except for negative parameter. Except for negative parameter where switching is not needed. P multiple of merged firm is equal to pre-merger P multiple of AC. In case you want to do weighted average, PAT of AC into P multiple, PAT of TC into P multiple divided by PAT of AC plus PAT of TC. What is combined P multiple? To justify the merger, whatever is the value of first company, whatever is the value of the second company, add them together. No synergy gain, nothing. Divided by post-merger earnings, which is AC plus TC plus synergy gain. Equivalent EPS or MPS is the concept for TC shareholder. Post-merger EPS or MPS into the exchange ratio. Same will be used to calculate gain or loss. For AC, take the normal value. For TC, take the equivalent value. Deduct the pre-merger value. Get the gain or loss. Multiply with the pre-merger number of shares. Get the overall gain or loss. Exchange ratio to maintain EPS, MPS, BVPS. EPS to be maintained on the ratio of EPS. MPS to be maintained on the basis of MPS. BVPS to be maintained on the basis of BVPS. Meaning in that also be little cautious in case, in this base values, in this exchange ratio part, if you want to pay something extra, please adjust it. You want to pay something extra, please adjust in the base value. Maximum exchange ratio, minimum exchange ratio. Minimum exchange ratio is from the point of view of target company. Maximum is from the point of view of acquiring company. Minimum consideration is equal to pre-merger value of TC. Maximum consideration is equal to post-merger value of AC minus the pre-merger value of AC. Post-merger value of AC minus the pre-merger value of AC. Value of original shareholder is a concept which assumes there is no synergy gain. There is no synergy gain. Add A, B, that's the post-merger value. That's the post-merger value. Divide by the overall shares post-merger into whatever share AC holds, whatever share TC is holding. Free float market cap represents the shareholding of non-promoter. Represents the shareholding of non-promoter. Overall cap into the shares held by non-promoter. Decomposing, MPS will be broken down into EPS into P multiple. EPS will be broken down into ROE into BVPS. Book value per share is share capital plus reserves minus fictitious asset divided by number of shares. If any bonus or split happens, overall value will remain same. Per share price will go down because of the number of shares increased. So your number of shares will increase, EPS will go down, MPS will go down, BVPS will go down, overall value will remain same. Minimum exchange ratio, maximum exchange ratio in a negotiation process. If the buyer is more powerful, you will put down the price. If the seller is more powerful, he will increase the price. Impact of revision in growth rate. In case there is a revision in growth rate, get the cost of equity, same cost of equity, new growth rate, the value of the firm will go up. Intrinsic value is the real worth. The proxy for intrinsic value is market price. Proxy is market price. This is okay. Exchange ratio on adverse parameter. If you have an adverse parameter, don't do switching of the base values. Gross NPA percentages, GNP in rupees divided by advances, and capital adequacy ratio, net worth divided by risk weighted assets. Net worth divided by risk weighted assets. DuPont framework, PAT margin into the asset turnover into the equity multiplier. That's technically called equity multiplier, which is nothing but PAT by sales, sales by asset into assets by equity. Promoter wants to reduce his holding. One way sell, he doesn't want to do, then you issue bonus. When you're issuing bonus, you'll issue bonus only to the minority shareholder. That will reduce your holding and increase the free float market cap. Minimum consideration for promoter to relinquish his holding, base price plus those extra benefits he was getting divided by the number of shares held by promoter. Decision on sale of shares, two situation: opportunity cost of capital given, opportunity cost of capital not given. If given, do earnings yield, compare with your opportunity cost of capital and then decide. If not given, compute post merger MPS, equal and post merger MPS, gain or loss at MPS level, gain, continue, loss, sell it off. If your PAT is already, if your earnings is already reinvested, post merger PAT is equal to PAT of AC plus its growth rate, PAT of TC plus its growth rate plus the synergy gain. Distribution of shares in case of partly paid share. See, you decided an exchange ratio, but what happens is, first company, that is the TC company, has fully paid share as well as partly paid share. They have fully paid share as well as partly paid share. If you have any partly paid share, convert them into equivalent fully paid and then decide the exchange ratio. You will understand with the example. Fund available for merger is nothing but how much extra borrowing you can take, which is debt equity ratio into the acquirer equity minus debt which is already there plus the amount of marketable security. Post merger shareholding is again weighted average. First company you have 4%, second company you have 2%, weighted average is 3.33%, we saw in one question. And the last part is slightly illogical, which you can manage it. 2 points I wanted you to add. One is for valuation of firm, there are two approaches, approach 1 and approach 2, and second is internal reconstruction note. We are done. We'll take a break. What time I resume? Maybe 2:30 or 3, I'll update you. It could be 2:30, it could be 3, I'll update you that.